Holy smokes everyone, the Federal Reserve has just responded to the American people's concerns in an exclusive 60 Minutes interview, but much of what they said didn't make it to air. I played the interview back multiple times to see what language the Federal Reserve Chairman Jerome Powell has changed, and I also studied for hours the uncut transcript on the full interview because much of what they discussed about wasn't included in the TV version. In this video, I'm going to break down exactly what they spoke about the economy, about inflation, about interest rates, the stock markets, the risks to the financial system, the digital dollar, the housing market, and interest rates. Now, many of Scott Pelley's questions have been questions I've been asking myself. It's been questions you guys have been asking. And much of the concerns he raised and risks for the housing market, stock market, and financial system as a whole are risks we've all been discussing in our community here. So what I think is happening by sharing these videos, awareness is being raised by the American people about how the financial system really works, how the economy really works, and about how unfair it is. Okay everyone, let's get into it. Okay, so first question, is the economy still in jeopardy? And here's a change of tune he's saying now. Before he was saying there's still a lot of work to do in the economy, but he's now saying the economy is at an inflection point. And he says that's because of the strong fiscal support and strong monetary policy support. He says, and of course he always has to talk up the economy, because if he says anything negative about the economy at all, that's going to lower confidence. He says the economy is roaring back much faster than he expected, and the jobs market is roaring back much faster than he expected. And he says the biggest risk to the economy right now is the worsening situation of the illness. And so some of my thoughts is I think the economy definitely hasn't recovered. They've just thrown money at the problem, and the real test for the economy will be is if they take all this support away, and if the economy is roaring back so strong, why are they still buying $120 billion worth of treasury bonds and mortgage-backed securities, and why are they still printing so much money? And the third question he asks is, everywhere he goes he sees closed storefronts and also help wanted signs, and asks, can you explain this recovery to me? And Jerome's response was, this is an unusual recovery, and some people are recovering better than ever, aka the rich are recovering better than ever, and the financial institutions, while other businesses like entertainment, travel, and restaurants, etc. are doing much worse. And then he asked a very important question, and this is something that I've been harping on about, and this is something that I think is going to be a huge issue in 2021 and entering into 2022. He says he knows a woman that was working full time but couldn't afford to rent and was still living in a tent. But last year she lost her job working full time in a restaurant, and he asked, when is people like that going to get their jobs back? And Jerome's response is, there were 8.5 to 9 million people last February that were still looking for work last year but are still unemployed today. And he doesn't give it a solution at all. All he says is a blanket statement, we're going to keep providing fiscal stimulus, and that's how the jobs are going to come back. So he doesn't say specifically how people in this situation are going to get their jobs back, and really things aren't looking good. And that's why I've been saying this financial system is so unjust and so unfair, and why I'm saying they have to get inflation under control now before it gets out of control. And in the interview later on, they get into inflation. I'll cover that in a minute. But this is why I keep saying inflation is theft. And it doesn't even matter if you got a job and you're working full time. If the cost of living and rent start to skyrocket, even if you got a job and they say, look how great the unemployment numbers are, what you're going to be is working poor. But they keep saying, look how great it is, the prices are going up. Look how great it is, the stock market and the housing market is going up. Yes, that's great for the rich, but what that could lead to is more tent cities popping up around the world. And so the next question he asks is, will the Federal Reserve keep supporting the economy until those on lower incomes get their jobs back? And an interesting statistic Jerome says is those on the lower 20% quartile of incomes still have an unemployment rate of 20%. So there still is very high unemployment. And guess what? Even if you got a job and you're working 2 to 5 hours a week, your class is employed. But that's definitely not enough money to survive. So again, you can't just look at the unemployment number to see how strong the economy really is. And another statement he makes here, it says, it seems like you're not expecting a recovery, you're expecting a boom. And this is Jerome Powell's response. Well, I would say that growth that we're expecting in the second half of this year is going to be very strong, and job creation I would expect to be very strong. Well, again, why you still got the money printers running hot? Why you still got interest rates at zero? if there's going to be a big boom. We had just 1 million jobs created last month if you include the revised upward for January and February, and I would think we'd like a string of months like that and make quick progress back to maximum employment. That is certainly in the range of possibility. As I always have to point out, there are risks to that forecast, but I think the base case forecasts that we have, and by the way, many others have as well. So he asked the Fed chairman, so when does the Fed start tapping the brakes in terms of interest rates and trying to cool things off? And so he gives the same statement as he always says, when employment gets back to their employment target of 4% or even lower, and when inflation gets to 2%, but not just 2%, over 2%, and modestly over 2% for some time. And this question he asks him is brilliant, and this is exactly what I've been saying. He says here, what the Fed has done traditionally is use economic normals to predict inflation and then raise interest rates, tap the brakes if you will, before inflation happens. He asks, is that what you're planning to do now? And what Jerome's response here is absolutely shocking. And guess what? He's not an economist. He's not an analyst. He's not a financial advisor. His qualification is, guess what? A lawyer. So why is he the head of the Federal Reserve? Well, guess what's been happening of late? He's changing all the FOI, the Freedom of Information rules. He broke the Federal Reserve Act in 1913 when he started buying corporate bonds and corporate junk bonds. He bought Apple bonds, he bought Amazon bonds. He pretty much bailed out the stock market directly, and I guess they're going to need a lawyer because George Gemin is now trying to sue the Fed. So listen to his response here. This is absolutely laughable. No, it's not. And really, what we've done is we've updated our understanding of the economy and therefore our policy framework to the way the economy has evolved. So all of a sudden, the way the economy has worked for hundreds of years has now changed. Economics 101 is now changed. The old things don't work. Jerome Powell's got it all figured out, the lawyer. The economy has changed, and what we saw in the last couple of cycles is that inflation never really moved up as unemployment went down. So he's saying here that there's been no inflation for the past 20 years since 2000, 2008. But I know, you all know, the cost of living is skyrocketing. But they're downplaying inflation because they can't afford to lift interest rates, otherwise the government could default on the debt. And also the stock market will come crashing down because there's so much margin debt, which he gets into later in the interview. And the housing market will crash because people won't be paying these crazy prices because their borrowing capacity would be reduced significantly. Listen to this. This is absolutely crazy, and we're all going to pay the price for his incompetence. He says here, we had unemployment at 3.5%, which is a 50-year low for much of the last 2 years before the pandemic, and inflation didn't really react much. Of course not. That's not the economy we had 30 years ago. That's the economy we have now. Listen to this. That means we can afford to wait and see actual inflation appear before we raise interest rates. So he's now saying, all of a sudden we can let inflation get out of control, and then boom, with a click of a button we can get inflation back in control. That's not how economics work. Once inflation gets out of control, it's very hard to tame. And what he's saying here, he's pretty much saying we're going to see some pain from inflation, but it's just temporary, so suck it up. How would you like it if I'd said, I'm going to come and punch you in the face. It's going to hurt, but don't worry, it's only temporary. Well, guess what? They're now punching your wallets. They're now punching your purchasing power. They're devaluing your currency, and they're saying, don't worry, it's only temporary, suck it up. And he's saying they can afford to do it. Well, who exactly can afford to do it? Him, the millionaire that made millions off Wall Street and is now the Federal Reserve chairman? How can someone that made millions of dollars on Wall Street be now the Federal Reserve chairman? I think that's a huge conflict of interest. Do you think those on lower incomes can afford costs of living increasing another 10%? Do you think they can afford their monthly budget increasing by $500? No, they can't. So I think he's very out of touch here. But he says here, now we don't want inflation to go materially above 2% and go back to, the bad old inflation days. Like I said in my video yesterday, in the 1980s, when inflation was around 20% and they had to hike interest rates 20%. Imagine if that would happen today. We would see complete economic collapse and a complete collapse in the stock market and housing market that we had when you and I were in college. Haha, good old buddies here. But at the same time, we do have the ability to wait and see real inflation, and that's what we plan on doing. Guys, this isn't going to work. He's bluffing here. Once inflation gets out of control, it's going to be very hard to stop. And guess what? Don't put it past them that they could underreport inflation, because if they have to lift interest rates, we're going to be in a world of pain. And another very interesting question he asks here about interest rates. So you're going to wait for actual inflation up to about 2%. When it hits 2%, how patient are you going to be? And again, listen to his response here. We'd like to see it on track to move moderately above 2%. So again, he's wanting to punch you in the face, hit your financial purchasing power. Inflation's going to be much higher than 2%, but he's telling you to suck it up. And the reason for that is we want inflation to average 2%. He's saying inflation's been below 2%, which is a complete lie, and we want it to be just moderately above 2%. That's the situation we're looking for, and when we get that, that's when we're going to raise interest rates. So it's going to be very interesting to see what the CPI numbers are for tomorrow, and it's going to be interesting to see they keep creeping up like they are, because in January it was 0.3%, in February it was 0.4%, and it's looking like it's going to be 0.5% for March. And another great question he asks here. So can Americans spend trillions on COVID relief and trillions more on infrastructure and social programs without setting a match to inflation? And then this is exactly what I've been asking. They're saying we can just spend as much money as we want. We can just have as much debt as we want. And we can just print more money and monetize the debt, and there's going to be no consequences. And so he pretty much says, that's not our area of expertise. We're not going to comment on that. We're not responsible for that. But he was the one advocating for fiscal policy because he says monetary policy is finished. That's what he was saying last year. But whenever he gets asked a question about this, he goes, look, that's not my department. You ask them. And listen to what he says here about the US debt, which is huge. I would say that the US federal budget is on an unsustainable path. Exactly what I've been saying. Do you think they can increase the debt from 14 trillion to 28 trillion in a matter of 10 years and keep on doubling the debt and think that's sustainable? And what happens if interest rate rises? They're not going to be able to afford to repay the debt. He says, meaning the debt is growing much faster than the economy, and that's kind of unsustainable in the long run, he says. But of course, it's not unsustainable right now when I'm in charge. That's going to be a problem we're going to deal with later, he says. Now's not the time. We'll deal with that on someone else's watch. And then they talk about the digital dollar. They say China is winning the digital currency race. And he says that the digital dollar is a high priority for the US. But because they have the world reserve currency status, they don't want to rush it. They don't need to be first. They need to get it right. And this is something that's coming, people, because the current fiat currency system is failing. And every fiat currency in history has failed. Not 50%, not 75%, 100%. And so what's going to happen during the next financial crisis, they're going to create these digital currencies and send you digital stimulus, and they'll say, look, you're going to have to spend this within a month, 6 months, a year. And if you don't, we're going to lower the amount, or they could have negative interest rates attached to it. And also this could be the way they hail in negative interest rates, because they can't bring them in now, because then people would just take their money out of the bank. But what are they saying now? Cash is trash, cash is dirty. We can't have you touching cash. So they want everything to be digitalized so they can monitor all your transactions. You will have no privacy, and that way they can tax every single cent you earn. Okay, now we're getting into the juicy part. They're talking about the Archegos hedge fund that defaulted on their margin debt, and it goes into how much of a crisis could this lead to if all of a sudden many other hedge funds or high net worth clients start defaulting on their margin debt. He says here, a private hedge fund called Archegos collapsed last month after borrowing billions from banks to make risky bet on stocks. Now the banks are out billions of dollars. How concerned are you the financial system is blundering into some kind of risky bets that led to the Great Recession in 2008? And this is exactly what I've been talking about. Margin debt is at all-time highs, even higher than 2000. And when margin debt peaked, that's what caused the 2000 crash, even higher than 2008. When I'll show you a chart when margin debt peaked in 2008, the stock market crashed, and now we're heading into a vertical line of margin debt, and this could lead to the next financial system collapse. And this is what the Fed chair says is concerning to him. What concerns about it though is, and unsurprisingly, frankly, that a single customer client, one of these large firms, could result in such substantial losses to these large firms in a business that is generally thought to present relatively well and understand risk. Exactly, but what do? They're now taking on so much risk because they can take on all the risk, and then the Federal Reserve will just come and bail them out, and the taxpayers will bail them out. And this is why we have to stop the bailouts, because guess what? They now know that they're too big to fail, so they're just going to take on as much risk as they can and say, hey Papa Fed, come bail me out. And then that's just going to lead to more inequality and more debasement of the dollar and more debasement of your purchasing power. So that is surprising and concerning, and you know we're going to understand that and get to the bottom of it. This would appear to be a significant shortfall and a failure on that front, and so that's something we're looking at. And this is something that most retail investors don't realize how big it was and how much of a complete collapse of the stock market it could have caused if all of a sudden all these banks start calling up their customers and checking to make sure they haven't got more loans with other banks from the stocks that they had. Okay, now we talked about the stock market, aka are we in a bubble? You've been watching various market indices breaking records almost every day now. Is what's happening in the stock market today, in our view, rational, or is it a speculative bubble? And what I think right now, according to all the indicators, the Warren Buffett indicator, the stock market is 201% now of GDP, which suggests we are significantly overvalued. Margin debt is at all-time highs. The only time PE ratios were higher was in 2000 and 2008. And once interest rates start to rise, people will start rolling back into bonds. He says, we do look at asset prices, and I would say some asset prices are elevated by some historical metrics, of course. So he's now even admitting it. This is huge because normally the Federal Reserve doesn't want to talk about the stock market because they don't want to seem to be manipulating the stock market, or they don't want the stock market to go down. But he's even admitting now, by the metrics which I just said, is that the stock market and some asset classes are overvalued. And this is just laughable. We don't think we have the ability to identify asset bubbles perfectly. Well, why are you in charge then? So of course we focus on having a strong financial system that's resilient to significant shocks, including if values were to go down. So of course, guys, you can't say it straight. The stock market isn't a bubble, but even he's kind of admitting here that it is. And guys, this was something that I reported on in yesterday's video, and now he's saying it in this interview. The securities industry has reported that 814 billion has been borrowed by people investing in the stock market. And they borrowed against their portfolios. That's a 49% increase since last year. And what you've seen lately is there's been some big financial YouTubers which are advocating to take on margin debt, which I think is so unresponsible when the stock market is at all-time highs. And again, another laughable response by Jerome Powell. That sounds like margin debt. Ooh, he's acting dumb here. I don't know that statistic. How can you not know that statistic? You're the head of the Federal Reserve. I really can't react to that statistic. Of course, because if he does, and he says this is a bad statistic, people are going to start selling off their margin, and it's going to cause a big stock market correction. Okay, the juicy part, interest rates. Near zero interest rates with us for how long? And again, he says when inflation gets substantially above 2% and when unemployment gets down, he's saying we don't have a calendar date. But what were they doing before? They were saying interest rates won't go up till 2023. So they were giving a calendar date. But now the interest rates are going to go up much sooner. They're saying we can't give a calendar date. Guys, these people that work at the Federal Reserve are laughable. But a huge change in his language is he doesn't say we're not going to lift interest rates in 2021. He says it's unlikely. Well, if they're not going to lift interest rates in 2021, why don't you say, no, we're not going to lift interest rates? Because he doesn't know how high inflation is going to be, and they may be forced to lift interest rates this year. Okay, now something huge he gets into, the money markets. You mentioned the money market funds a few minutes ago. Many people invest in the money market funds. They froze up during the pandemic. They froze up in 2008 during the Great Recession. Is there something fundamentally broken about the market? And his response here is huge. There's structural issues, and we know this, and it really is time to address it decisively. So he's admitting here the money market system is broken. This is something I've been saying here. The financial system is broken and people are finally starting to wake up, and even Jerome Powell is admitting that it's broken. So if the Fed admits it's broken, that's huge, and it's definitely broken. He says, and that is just sometimes there arises a situation where people want to take their money out and it's difficult for many market funds to turn their assets into cash quickly enough. Again, that's why they want digital dollars, so you can't do this in the future. And so what has had to happen twice is the Fed came in and became a source of liquidity for money markets. So after the global financial crisis, when it happened for the first time, we did for some reforms. Those reforms worked a little bit, but they didn't really do their job because once again, this time we had to step in and provide liquidity on the behalf of the government and bail out these private businesses. Again, the bailouts are never going to stop. They keep bailing out the ultra wealthy, the ultra rich, and they gave us the crumbs. So people would shut up, take their stimmy, and not ask any questions. And even he admits here, and you know when something happens twice, it's really time to go ahead and fix it. just like they should. Every private business ought to have the ability to deal with a range of plausible things that might happen to it. And that's true of many money market funds as for it is for other businesses. And I completely agree. They can't keep relying on Papa Fed to come and bail them out every time they get a boo-boo. Whatever happened to the emergency fund or the rainy day fund? It's time for these big corporations to stand on their own 2 feet and go out in the big world like a big boy. So we ask him, well then how do you fix it? And guess what? He doesn't know how to fix it. I just think there are many ideas out there and they're all under discussion, by the way, internationally as well. Essentially, what it all boils down to is that money market funds are going to need to be resilient enough so that they have liquidity shock like this, they can handle it. So again, no solutions here. They have no idea how they're going to do it. Who knows? Well, the bailouts could just continue. Okay, and then he asked him a few more boring questions and some other questions he already asked earlier. So everyone, to summarize, there are still huge risks in the financial system right now. They've not fully recovered. Inflation is going to get out of control. The Fed is going to let it run hot, but it may get too hot for them to handle, and the public, I hope, wakes up to the theft of inflation, and they may be forced to lift interest rates much sooner than they expected, like I've been saying, and they're now admitting it. And that's going to mean there's going to be a big correction to price in these new interest rates in the stock market, in the housing market, like I've been warning, but no one was listening. But now all the facts are starting to come out for the public to see. So everyone, I urge you, don't FOMO in right now. Get ready. There's going to be some huge things coming. The Fed could downplay inflation. They could underreport inflation because, like I said, they do not want to lift interest rates. But again, it may get too hot for the handle and they may have no choice but to lift interest rates. This is no time for FOMO when stock markets and the housing market is at all-time highs. For all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you up to date on the latest that's happening in the housing market, in the stock market, and global finance news. If you're bored, I'll put up some of my other videos here. I'll see you there.